Excellent. Good. So welcome to this cold February's version of Finance Mastery. It's, as I said before, it's freezing here. It's about 18 degrees in sunny Spain. So I do feel for you guys. Gary's out actually on site in -2 at the moment. So good on you guys. It's keep up the good work, as they say. And welcome, James. Nice to see you. We've got a smallish group, so you can keep your mics on. If there's a bit of background noise, then please just switch it off, just so it doesn't sort of get in the way. I will sort of be using the chat box, so if you know where the chat is, if you get your toolbar up and click on more, it should come up there at the top. So please do type any questions you've got as we go in there, and I'll make sure that we cover all of those as we go through. So Finance Mastery, if we look at finance is one of 6 workshops that we have. They rotate every 3 months. I know some of you have been to some before, and they go through self-improvement, marketing, sales, and obviously this one really is about the finance side, looking a little bit about our mindset around it, because I'm guessing no one here is a qualified accountant. James, I know you do some of the sort of numbers side, but we don't have any accountants, so that's quite good, because I'm generally rude to accountants. So having been one, I'm allowed to. And we're going to go into really the importance of numbers and why you can't really play this game of business without an understanding of it. So that's going to be our focus today. So what I'd like you to do is just think about what would you like to get out of the workshop today. So if there's a particular question you want to ask, because we're small groups, I can go a little bit off-piste and answer your questions, as long as it's not too far off-piste. So just have a think, type in the chat box, if there was one thing you'd like to get out of today's session on finance, what would that be? And then I can make sure I cover all of those during our time today. If you put it in the chat, then I know at the end I can go back to it and make sure I've covered it. Is anyone typing? I'm not seeing anything. Key financial metrics. Yep, good. Yep. Knowing how the top line affects the bottom line. Cool. Yep. We can definitely cover a bit of that. I'm sure Gary can't type, so with his in his mittens, so I'll let him off this one. Oh, he's actually been able to. Oh. And pricing. Okay. I'm not going to go probably to that level of detail in today, Gary, in pricing, but I think you'll get an essence of where you need to be when we look at the budgeting side of things. So remind me at that stage, and if we've got a bit of time, I'll go into a bit more detail there on pricing side of things.
Okay. Can you hear me? I just wanted to quickly clarify what I meant.
I can't hear you, Gary. You're all muffled.
Hold on a sec. Can you hear me now?
Yeah.
Okay. I just wanted to quickly verbalize it because it's hard to type with frozen fingers. So what I meant by that was working through a year, or thinking of the year's projection, and then sort of working backwards to what a day rate is. Because my day rate now is, it's an okay rate, but I don't know whether I'm 100% on par, because I've just literally had my van insurance come up, my liability insurance come up, and then one other thing's come up on my BNI subscription. So that's a few £1,000s worth of things that need to go out, and it's just having a budget for the year that's covered, so that I don't have to get stung and have to use my credit card and then pay myself back.
Okay, should cover that when we look at the budget. So
Yeah.
if you've got any questions, then that's the time to raise it at that stage.
Yeah, it's not a big deal if you can't. I'm sure we'll have a chat about it eventually sometime. I don't want to cry about it right now.
We'll certainly be looking at the overview of it. We might need to go in a little bit of detail offline.
Yeah.
Okay,
no problems, mate. No worries.
So, cool, excellent. Excellent. So I think there's no reason why we're not going to cover all of those and a lot more besides. So let me come back to it. So I start off these mastery workshops with this formula. Some of you have seen it before because for me it is just fundamental to success in anything, but especially in business. So what do I want to have? What are my dreams and goals? What is my attitude, knowledge and skills? And what do I actually need to do? So when we're looking at this from a business perspective, sorry, let me come back to that. It's gone massive. The first thing we've got to understand is what do we want to have? Okay, so what are our goals around finance, and the numbers? Now, in a way, we've got to sort of separate this from the business goal of actually potentially making money, and we're going to come on to that in a bit, and the actual goal that we want within relationship to this workshop is at what level of finance knowledge do you need? Okay, so if you are the business owner or you're in a senior position in the business, you're probably not going to need to know the in-depth accounting systems and processes to become an accountant. I'm not here to teach you to be an accountant. What I'm here to help you with is to actually understand how you score the game of business. Okay, so but I would always say that if any stage you don't know, you look at a set of numbers and you're not sure, or you're afraid of numbers, they don't inspire you, or you're not looking on a regular basis, then that's the bit you've got to get over. You've got to start to love the numbers, because the numbers are really what shows what's happening in the business, and they're the logical side of things, that the reality of what's happening, which is really what I'm going to go into next. So we're going to start off with attitude, knowledge and skills, so our beliefs. And a lot of this is around about what beliefs do you have around numbers? So when I say finances and numbers, and when I say money, what are the beliefs that you have? And too many people put too much emotion into the numbers, okay, because they are an emotional thing. If I've got money, I generally feel happy. If I haven't got any money, I feel sad. Okay, so we've got to understand that money is far more than just the numbers, but often it's this confusion between our emotions around them and the logical reality of it that trip us up, certainly where it's our own business or our own money. So I'll give you an example of this. So let me pick on Dave, as he's shooting off in a bit. So if you unmute yourself, Dave. So Dave, I'm going to give you, well, you're going to go to the casino, okay? And you've got £1,000, to go to the casino. How do you feel right now if I've given you £1,000 to go to the casino?
You're quite happy with it, yeah.
Quite happy with it, okay?
Yeah.
And so you go to the casino, you bet on a few things, and you come away with nothing.
Yeah.
How do you feel?
It wouldn't be my money I'd lost, so you'd be quite happy. Yep.
Yep. Now, if that was the last £1,000 that you had in your bank account, and your family have gone without food for a week, how would you now feel about going to the casino with that £1,000?
You wouldn't go, would you?
No.
No. Mm-hmm.
And if you had £1 million in your bank account, and you went with £1,000, how do you now feel?
It wouldn't bother you one little bit, would it? Drop the ocean.
So the process of going to the casino and actually doing what you do is exactly the same in all three accounts. You have an equal chance of success and failure, irrespective of what's happening outside of that. yet the emotion that you take with that £1,000 is completely different. And that's what we've got to understand within business, is the same thing is going on inside your head. The game of business is exactly the same, as the game of gambling, slightly better odds, I would guess, I would hope. But your emotions that you bring to the table will change depending on how you see that money. And I'm not saying it's a bad thing. What you've got to understand, but you've got to understand why you feel that way. Because often, you'll be your last £1,000 and you won't go to the casino and spend it. You won't spend it on something when really you should, because that's the only way you're actually going to get through this. Now, I'm not suggesting you go to the casino. I'm saying with it, investing in the business. So it is different. I know James. James is. You're not a shareholder of the business.
Yeah.
So our shareholder. So it's different. If you own a percentage of the shares, whether you own it all your shares, whether it's your business you started from scratch, or you've taken over somebody else's business, whether it's second generation, third generation, is all going to be different. So we've got to understand that the way that our brains are set up is we have this left side of our brain, which is our logical side, and we have this emotional side. And for us, when we're running businesses and in charge of businesses, we've got to understand that sometimes they work together and sometimes they work against each other. Sometimes logical and emotion will fight against each other, which will cause you stress. Other times they'll work together, which will give you real strength. So we've got to really start thinking, when we look at the numbers, is to just tone the emotion down, or when we are emotional, say, fine, that's okay to be emotional about this. It's there to help me, but actually in this case, it might not be. Okay, so the less we can run our business on emotion, the better. I'm not saying we don't go with gut feel and things like that, but first off, we should go from the logical. What do the numbers say? Because rarely do the numbers lie. The numbers are just a record of what's happened, as a result of what we've done. So what happens is, when we start looking at numbers, the way our brains work is this sort of three-step process. We have a thought, which creates a feeling, which creates a behavior, which reinforces the thought. So let's take a situation. I'm looking at my monthly accounts, and I make a £10,000 loss. Okay, just in that 1 month. The other months have been profit. I make a £10,000 loss in that month. What do I think now? So Neil, you've just made a £10,000 loss in a month. What are your thoughts?
Well, that maybe we haven't clearly we haven't performed particularly well. We're not going to be feeling that great about it. We probably put all the time and effort into trying to get the same amount of sales in, but hasn't quite worked out for whatever reason.
Yep.
So not particularly great.
Not great. So you've probably got some negative thoughts. Yeah. So those negative thoughts, are they going to generate positive or negative feelings?
Me personally, well, clearly they're going to be negative.
Yeah.
But I think you're going to want to, do what you can to.
Yep. So you're going to get a negative feeling.
Yeah.
Yeah. Now, who here likes to have negative feelings? No, it's shit, isn't it? So if we have a negative feeling, what would our behavior start to come? Would we be more inclined to look at our numbers or less inclined to look at our numbers? Less inclined. Because last time I looked at my numbers, I got a bad feeling, and therefore we're going to be inclined to look less at our numbers. So, and if we look less at our numbers, then our thoughts will change. Perhaps if I ignore it, then I don't get the negative thoughts, therefore I don't get the negative feeling, and we start to reinforce bad behavior. So what we've got to understand is, when we look at numbers, they will make you think, because you can't help but think. The feeling will come in, but what you need to put in here is a filter. Okay, so we need to put a filter between the feeling and the behavior. I feel this. Yeah, if you've made a loss, of course you're going to feel bad. But I need to put a filter in here and actually, really before I do the behavior, almost take me back to another thought, and let's find, okay, so now let's think of a positive thought that could then drive a positive feeling that would then drive a positive behavior. So if I've made a £10,000 loss, James, and I've gone through that loop, how can I change that negative feeling into a positive thought?
Well, through the filter, you're saying put a tool in place to change the mindset.
Yeah. So how would I change it? How would I go about doing that? What sort of thought could I have instead of that negative one?
It's how you can learn from those numbers. What else can you do to take away from what you've seen? Is everything been done correctly? Is there anything that's been missed out? And what behavior can we change for the following month? Yeah.
So okay, we lost £10,000 last month, but is that guarantees? If I've lost £10,000 this month, is that a guarantee I'm going to lose £10,000 next month?
No.
No. If I do nothing and stay as I am, then is there a chance I'm going to lose £10,000 next month? Yeah.
Yeah.
So that change of belief has always got to be, I can actually do something about that. As soon as you lose the belief that you can do something about it, then you're buggered. And that's why people then start to ignore figures, because they believe they can't do anything about it. And the only way to get rid of the pain of looking at the numbers is ignore them. And that's why people get into massive debt, is because they feel helpless about doing something about it. They don't know how to do something. Now, if you don't know how to do something, what should you do?
Ask for help.
Ask for help. Ask somebody. Okay, because you're not the first person to have lost £10,000 in a month or had a shit month or a shit year. So we've got to start thinking outside and saying, right, okay, if I don't know how to do this, then either I've got to learn, or I've got to get help to actually achieve it. But the same thing happens as well. Let's say I've made £100,000 profit this month. Yeah? What sort of positive thought have I got?
Feeling chuffed with yourself.
Chuffed, I've done really well. Pat on the back, well done. So that creates a positive feeling. And that will then drive a behavior. Now, what could that positive behavior be that might cause me problems in the future?
Maybe go and spend it on something that you don't actually need. Maybe not reinvest it back in the business.
Yeah, complacency.
Complacency, yeah, you might think, okay, right, well, I've made it, rest on my laurels. I don't need to do that again.
Because what did I say down here? If we've lost 10,000, is that a true guarantee that I'll lose £10,000 next month? No. So if I've made £100,000 that month, is that a guarantee I'm going to make £100,000 next month? No. And actually, if I looked at this and did the same thing, or I've got a positive feeling, put the filter in place and said, right, what could I do now here? What might that then influence me to do in the future?
Repeat the good behavior or good thoughts.
Repeat the good behavior. But also, as I did here, I said, look, 10,000 doesn't mean I'm going to lose 10,000 next month. If I do something to improve it, and I turn it around. If we had
20 grand the next month and balance it out, balance that loss out the next month.
The same is true when I make 100,000. What should I be thinking? If I went through the same thought process as I did having lost 10,000, what would I be getting this filter to stop me being complacent? I would start to think, how can I
repeat it?
Hit it. How can I make more? That's a fantastic month. Brilliant. Well done. Right, let's beat it next month. See, the number itself is irrelevant. It doesn't matter. This could be 1 million. The process is to stop that feeling coming in, or understanding you're going to have potentially a positive or negative feeling, and actually go, it's irrelevant what it does. It's just a number I need to beat next time. There needs to be a logical process that whatever number I show, yes, celebrate, I'm not saying don't, pat yourself on the back, but the process after that should be, how do I actually go and improve it? If we can remove the emotional feeling that we get from a loss and a profit, it really doesn't matter. Because the one thing you've got to understand, I've got it here, if we can go to that one, is all numbers are a mirror on the past. It's happened, it's done, it's gone. You can't change it. The only thing we can do is learn from it and use it to move us forward. So what happens with this is we get a fear. The positive one's okay, but what holds us back the most is, when we think about numbers, we get this false expectation appearing real. We think that we lost £10,000 this month, therefore we're going to lose it next month, the month after. If I keep losing money, then I'm going to lose the house, I'm going to lose the family, and I'm going to end up dead under a bridge in Woolston. Okay, and those fears will stop you making the right decisions. So we've got to start treating our numbers as purely a reflection of past actions, but not a prediction of future actions. If we change what we do, we don't like the result, we change what we do and we get a better result. If we've done well, then fantastic. We've done good results, but could we do better? So if you think about a sports person, when they go out, a runner who completes their time in a certain time, that's fine. They'll celebrate for 5 minutes, and then next time they're out, they want to go and beat it again. And that growth, that movement forward is what we're looking for in this, is we take away the emotion, it just becomes a logical decision to move forwards. So figures in our business are just a scorecard. I don't know, I love my golf, so I'm actually lucky enough at the moment to play golf out here. So I'm playing golf every week, and I'm playing a new course, and I'm scoring not brilliantly. Okay, and I've actually got my scorecards here. I'm sad enough to keep my scorecards. But can I go back and change that score? It's done. Okay, now I can use it to get upset, and go and cry and say, well, I only scored 24 points today, and I'm not going to play golf again. Or I can use it to actually say, right, how do I get better? And that's what we've got to understand with our numbers, is we've got to learn to love the numbers, to know that they're an important part of what we do, but they are just a reflection of the past. And it's not about that, it's about what we do to move it forward. So when we think about them, they're a score sheet, a barometer, they should be a motivator. What I love about them is they are universally understood. Doesn't matter what business you're in, what country you're in, when it comes down to, if you get the languages, you can come back to, if you understand the numbers, you can play any game you like. And they allow you to make better decisions. That's the key to this, is the more you understand the numbers, the more and better decisions you can make. So if you take the analogy with golf, if you just keep the score of, right, well, I went round in 10 over par, that's okay, that helps you. But actually, if you really want to play the game well, you need to know how many fairways you hit, how many greens in regulation you hit, how many putts you took, how many sand saves, how many rescues. You know, you break it down into more detailed components, and then you look to improve each one. And that's really where we'll come on to when we look at our key performance indicators. So once we've got an understanding of our beliefs and just looking at numbers as a scorecard, then we've got to start understanding how the game of business is played. Okay, and this is the same, whatever business we're in, the same game is playing. So Gary, who's sitting there on his own, you know, is playing this game. James, who's running a multi-million-pound business, you know, with teams around the world, is playing the same business. So playing the same game. The top, there are shareholders, okay, owners of the business. Those shareholders appoint a managing director whose job, and that's why I use MD, not CEO, because the managing director manages the directors. And the directors being, between these two are interested in generating the profit and shareholder value. Because a shareholder is playing the game of return on investment. So these guys want an ROI. So I invest my money in this business and I want a return. How do I get that return, James, as a shareholder?
Well, through your dividend or through your balance sheet value.
Divi and value. Okay, so that's the only way I can get a return is I need more dividend, I need more value. So therefore I appoint the managing director, and the way I get a dividend is profit, and the way I get value is profit. Because value is a profit times a multiple. Okay, and I'll explain that a bit more later. So as an MD, your number one goal is to generate profit in your business. Okay, do that, you keep your job. Don't do that, then you should be sacked as an MD. Now, where you own your own company, as a shareholder, the first question you've got to ask yourself, have I appointed the best managing director to run my business? And in Gary's case, he should be saying, why is my managing director out on site knocking nails into pieces of wood when he should be running my business for me? But in a small business, as we'll see, we have to be multitasking. So then the managing director's first director role needs to be a marketing director. So how do I get the leads into my business? How do I drive new business to come in? Next role is the sales director. So how do I convert those leads? Yeah, and between those two are in charge of sales. So that they look after the sales metrics of the business. Okay, so if the MD is saying, actually, we're not generating enough profit because we're not generating enough sales, I need to go to these people and say, why am I not achieving sales? And if I go to the sales director and say, hi, Mrs. Sales Director, yeah, why are we not generating sales? Who does she blame?
Marketing.
Marketing. Well, I'm not generating enough leads. So I go to the marketing director. Who does he blame?
Sales.
Sales. Not converting. So my job as the managing director is to manage this relationship. And the only way I can do that is I need to know the numbers. Otherwise, it's an emotional thing. It's whether I like the marketing director better than I like the sales director. We don't manage a business on that. It's purely about show me the leads that you're generating, show me the conversion rate, and the resulting factor is that. And actually, don't care what these numbers are. All I want them to be is better. Even if they're great, fantastic, well done, brilliant week. How are you going to make them better next week? We add in operations. So operations is all about our direct costs, cost of sales. And between those three now, It's about gross profit. So if we're not making profit and we're not making gross profit, and the MD blames the operations or asks the operations director, who does the operations director blame?
Sales for not converting the
Sales and marketing. Yeah. And now suddenly these two were sworn enemies. Yeah. Now they've got somebody else to gang up with. So now they turn around and say, well, no, we're generating the sales. You're just not producing it profitably. So now the managing director's got to manage this relationship between these three, which they can only do by knowing the numbers. Okay. Then the managing director gets a bit of support from the finance director, because the finance director should help with the numbers because that's what they're trained in. But they're also responsible for the overheads and the balance sheet, the cash flow within the business. And between all of those people, we're in charge of the net profit. So suddenly, these three now will gang up on the finance director and say, well, we're doing fine. It's just you're overspending on your overheads. So cut your costs, cut costs, cut costs, cut costs. So the finance director says, right, okay, we'll cut costs. I'll cut your operations budget. I'll cut your sales budget. And I'll cut your marketing budget. Now we're all screwed. So this MD's role is to manage the directors, manage these, to balance this out, to know the numbers, to actually drive the profit. If the person at the top doesn't know how this works, then you're screwed. Because you can't manage it, because everyone will be blaming everybody else, and then you'll have silos in your organization, and they're all playing different games, looking after themselves, and it's just a one-way journey to nowhere. And if you're all of these people, as a few of you are, then it's even tougher, because how much time do you spend in each one? You haven't got enough time to do the job, let alone record the numbers. And therefore, if you're not recording the numbers, you're not able to actually make the right decisions. And then the final one is HR, which is really about ensuring you've got the right team, that they're happy, and that gives you the longevity of the business. Because a business that loses all its people regularly just can't survive, it can't carry on. And again, to do that, we need numbers, because HR, people, is very emotional. But I don't care about the emotion. What I care about is show me the numbers. Has anybody watched Moneyball, the film?
Yeah.
Yeah. So if you watch that in light of this, it makes a lot more sense as well. It's a great film in its own right, but it took the game of baseball and took the emotion out of it and just looked at the statistics, and built a championship winning team. Because
the Brad Pitt one, is it? Is that
Brad Pitt one, yeah. And that's what he did. He just said, look, I'm not interested in the emotions of this. People are hiring on emotions. Let's take the best players because everyone thinks they're the best player. And he said, no, forget it. I look at the numbers. I know what numbers I'm looking for. And they got an analyst to actually come up with an algorithm. And from that, they managed to recruit the best players for the lowest price, so they could have more good players. And that, in essence, is what you're doing within your business. Is you look at the numbers, remove that emotion. So let's go back up to the shareholder then. Let's start with the shareholder. The shareholder's number one goal, as we said, is return on investment, and I need dividend and share price growth. So I want the price of my shares to go up. In order to do that, I've got to make profit. A company that isn't making profit, or it's a little bit different, because when you look at traded companies, a lot of high value traded companies don't make any money. So Amazon in its first 10 years made no money, had an amazing shareholder value. Okay, Tesla's the same. I'm not sure if Tesla's made any money yet. Okay, so the game is to make profit. In that game, it's the expectation of future profit that they're gambling on. You know, will this company make money in the future? Yes, it will. Will it make a lot of money? Yes, it'll make a bloody lot of money. Therefore, we have these big valuations. So that's what we're looking at. It's the profit now, but its ability to make profit into the future that is key. So when we come to a business valuation, how businesses are valued, it's generally done on these two things: net present value of future cash flows, so future profitability coming into the business, or a multiple of earnings. So it's the same thing. One is sort of projecting into the future and discounting them. The other one is just saying it's a multiple of earnings. The most used is this one. Okay. Now, does anybody know what EBITDA stands for?
Earnings before interest, tax, and depreciation, amortization.
Excellent. Brilliant. Good. So I'll come back to that in a second. So it's an earnings before interest, tax, depreciation, amortization, plus the net assets minus net liabilities on the balance sheet. Okay, simple as that. So what your balance sheet value says and the multiple of earnings. Now, which one of these do you think is the biggest influencer on the value of your business?
Net assets, I'd say.
Assets?
Yeah.
Okay, so let's look at this then. So if I've got a business that makes £1 million profit, yeah, and has got £1 million on its asset book, and I'm going to work on this business. So at the moment, and let's say this multiple here is 4 times. Yeah, so I've got a valuation of 4 million plus 1 million, yeah, which is £5 million valuation. Does that make sense?
Yeah.
Okay. So now I'm going to work really, really hard. So on your base, if you're saying it's net asset, so I'm going to retain cash, yeah, in the business. So I'm going to retain next year. I'm going to keep £2 million on the balance sheet. I'm going to double the amount of cash my business holds. I'm doubling my net assets. How much is my business worth next year? 6 million. So I've made a good improvement. If I change that tact and said, right, I'm going to spend that £1 million, yeah, so I'm going to have 0 net assets, but I'm going to use that to grow profits to 1.5 million, yeah, and I'm going to use it to employ more people and get this figure up to 5. What's my valuation now?
7.5.
7.5.
Yeah.
So holding cash and holding assets in the business is not the way you get your best valuation. Your best valuation comes from increasing your profit and increasing your multiplier. Because you'll only ever get 1 times cash in bank, yeah, whereas you can get 5. And if you're selling to a PLC, yeah, they can be offering you 10 times plus.
So when you say assets, Kevin, could you also include investments in assets as well? So you'd say it's not necessarily good. You could reinvest the investments back into the business that way.
When you say investments, what do you think?
So if investing in property, for example, that's an asset, isn't it? That's an asset.
Yeah, but it's only 1 times. You only get the value of the asset.
Mm-hmm.
Yeah, if I'm buying a house and it's worth 500,000, what am I going to pay for it?
Yeah,
500,000. I'm not saying it's a bad thing, but what I'm saying is if you put that effort, into growing profit and growing the multiple, that's where your valuation comes from. That's where the goal is in the business. It's not just storing assets in it.
Kevin, what's the some strategy in terms of that increasing that multiplier?
I'm going to come on to that.
Okay, fine.
Yeah. Okay, I just needed you to understand why we're doing this. There's a multiplication of the earnings. I'll tell you what EBITDA is in a minute, but that's where the valuation comes. That's where the value, the extra wealth. Holding assets does not, it increases your business by the amount you hold, but it's not the way to actually sell a big business. Okay, and it's a misconception. People say, "Oh, I need to store cash, and I need to, if I invest in properties, it's okay." But your focus should be building profit and your multiplier. So EBITDA. So if we look at a typical company, sales, cost of sales, gross profit, overheads, net profit. EBITDA is your earnings before interest, tax, depreciation, amortization. So it's basically saying it's this figure for most people before things that aren't due to trading activities. The amount of interest you pay is not to do with the trading business. It's a financial decision of whether you finance assets or buy assets. Taxes you pay is not to do with your trading, it's to do with what the government levy on you. Depreciation is not to do with trading, it's how quickly you write off your assets. And do you know the difference between depreciation and amortization? No? And this is one of the key things you've got to understand with accountants. Okay, accountants love creating terms that you don't understand, which means you have to employ them to actually decipher it for you. These two are exactly the same. Depreciation, though, is the writing off of tangible assets, so assets that I can touch, so cars, boats, computers. Amortization is intangible. Assets I can't touch, so patents, investments in companies. Okay, it's just another word for the same thing. It's the write down of value of something that is going to last a number of years. And do you know why we depreciate and amortize assets?
It'll be worth less over a period of time.
Yeah. So if I buy some stock, yeah. So if I buy £100,000 of stock, yeah, in a 12-month period, is that stock going to be used up? Generally speaking.
No, because it's stock should always be there.
So if I buy stock on the 1st of January, yeah, will that stock, £100,000 stock that I bought on the 1st of January, be there on the 31st of December?
No.
No, it might be 100,000, but it will be a different stock, won't it? It won't be the same items, unless I'm really shit at selling stuff and can't sell it in a year. So that stock gets used up in the year, therefore it's a cost of sale because I've sold it in the year. If I buy a car, yeah, which I use for the business, yeah, which would be an overhead. Yeah, if that car, let's say I bought a £100,000 car or van, and that car lasts me 5 years, yeah, and it reduces in value over 5 years, and to write that off in year one wouldn't make any sense, would it? I'm getting the benefit of that asset over 5 years. So I use this to depreciate it by £20,000 a year over 5 years into that. Okay, so it's the writing off. So I could say, right, I'll write it off in 5 years, or I could write it off in 10 years. And that would affect my net profit, and therefore affect my valuation. So what happened? People were using these things to manipulate this figure so that their multiple would be on a higher figure. So when they said to valuation, said, look, all the things that you can manipulate, we're going to ignore. You can manipulate taxes, you can manipulate interest, and you can manipulate these. So we're going to ignore those for a valuation purpose. But for general speaking, what we're talking about when we talk about EBITDA multiplications, we are just talking about net profit. How do we increase the profitability, this company's ability to generate profit on a regular basis? That's really what we're focused about. The rest of it is more of a calculation when we actually come to negotiate a price. And do you know what the real value of a business is? How you really calculate the value of a business? It's what somebody will pay and somebody will accept. That's the value. You can come up with whatever number you want, but if no one's willing to pay it, it ain't worth that amount of money. It's the same value for anything. A house is only a value of what somebody's willing to pay and what somebody's willing to buy. Okay, so when we build businesses, to sell, we've always got to build it with the sale in our mind. Who are we likely to sell this to in the future? If there's more of those people and they're wealthier people, then we'll get a bigger value. Yeah, if we're selling it to people with no money, and no idea, then we'll get nothing. Okay, so we want to build it with a view to who we're selling it to. So the average the multiplier. So the average multiplier is around about around about 2.5. Okay, so this is a small business. So I would say this is probably sub 2 million turnover. Would sell for around about 2.5, and that's the average. Okay, so you got to think the average is that. So the majority are going to be sold down here, and a few will be up here. Now, why do you think it's 2.5? What do you think drives that?
Increased profits, I guess, during the increased turnover, maybe, then increased profits.
Yeah.
Reductions in cost of sales, I guess.
What did I say back here when I said about the valuation here? Net present value of future cash flows.
Yeah.
So it's saying that for that business, am I guaranteed to get the amount of profit that you're making now? How guaranteed am I to receive that for the next number of years? So let's say it was, let's say go back to here, it was £1 million. So £1 million profit you made in 2020. If I knew without a shadow of a doubt you would make at least £1 million of profit for the next 20 years, how much would I pay for you? How much would I pay for your business? Guaranteed, 100%. You'll make at least £1 million a year for the next 20 years.
20 million? There's no return then, is there?
No return then, is there? So what would you pay? What would you pay if I had this fantastic business that was guaranteed to make 20 million quid, £1 million a year over the next 20 years?
Would you pay 10 million to double your money?
Yeah, you'd probably pay 10 million, wouldn't you? 10 million, and I know I'm going to double my money in 20 years. That's a pretty good investment. I mean, I'd do that all day long. So therefore, what's my multiple?
2.
£1 million, and you're going to pay 10 million. 10 times. So my multiple is 10. So if my multiple is less than 2.5, what's that saying? So if I'm only going to pay 2.5 million for this business, what's that saying about the longevity of those profits?
Shorter.
For sure, it's not. There's too many factors involved here that it's unlikely I'm going to get more than, on that basis, 5 years at that profit level. There's too much risk involved. There's too many factors. So if we want a higher multiple, either I've got to show that my profits in 5 years are going to be probably 5 million or even 10 million, yeah, or that the security of that income is almost guaranteed. And so how would I ensure that security is guaranteed? What do I need in place? Contracts, clients, people, a great niche in the marketplace, a great brand, systems. Okay, so I need all of these things in place, these foundations, which gives that strength to say, actually, that is guaranteed, and we're also on a growth path that will mean that you will get more than £1 million. And that's why the likes of Tesla, Amazon are valued at, I mean, their multiples are in the thousands, tens of thousands. Because people look at them and say, this business is not going away, it's really strong, it's really well run, and it will continue to make profits well into the future. And the average multiple of PLCs, you know what the average multiple of PLCs is? The trade on the stock exchange?
5.
15.
50. Or 15.
15. So if you look and you go on buy a copy of the Financial Times, what you're looking for there is the price, the PE ratio, price earnings ratio, share price to earnings, and you'll see it's some down in sort of the 12s, a lot in the 20s, but I think the average is about 15. Okay, and this is where businesses get sold for really good sums of money, because if they buy your £1 million of business, yeah, for 5 times multiple, so they give you 5 million for it, and they absorb that into their company that has a 15 times multiple, how much is their company now worth?
20.
Or 15, isn't it? Because they multiply your £1 million profit by 15, so they're now worth 15.
Oh, you don't take their existing business as well.
I hadn't put the value of that in.
Okay.
But
Yeah.
So they would pay you easy 5 million, because as soon as they buy you, they're worth 15 million. So if they've got 3 times multiple, they're not doing anything. They haven't even saved any money or done anything. So if we can build our businesses that are attractive to those, then we're onto a winner. And you've heard of venture capitalists, VCs, and private equity funds. Basically, they do the brokerage between that and that. So they want to buy you for 3 times, yeah, and then they'll sell to these guys for 10 times by doing exactly what you can do. But they do it day in, day out, and that's why they make shitloads of money, for my mind, doing fuck all. And that's the same as an estate agent, but we won't go on to that. Apologies to all the estate agents watching this. How's that done that? So what we want to be able to do then is take this sort of average business into a higher than average. So there are factors here that we can do through the Action Coach system to actually get this multiple up towards, 4, 5, 6 times. Sometimes you'll get 10. It's fairly rare, and if you get that, to me, that's a bonus. It's not necessarily because what you've done; it's because who you're selling to. So what we've got to do is therefore look at what gives us that multiple, and what gives us the multiple is the 6 steps. Okay, so these are the 6 steps that Action Coach is built around. Mastery gives you that first level, that 1, 2, 3 times multiple. Niche drives the EBITDA figure. The systems and processes in to give you time drives the multiplier up to 4, 5. Building a team, 5, 6. Yeah. And then if you're actually not involved in the business at all, then it will increase it even further. And if you then go into diversification and acquisitions, then you can actually drive both of them. So you can actually take your £1 million business, turn it into a £5 million business through acquisitions and diversification. So the whole Action Coach process was built around driving the value and wealth in the business. First off, it's got to pay for you. After that, you're looking for that potential to exit in the future. So you've got to think about this. What gets measured gets improved. If we can't measure it, we can't improve it. So we've got to start thinking of our business as just a load of activities that are going on, every one of them. The more we can measure it, the more we can break it down to its bite-sized chunks, improve it, put it together, and move it forwards. So the first area is we've got to look at our financial measures. Okay, so what are our financial measures within our business? Well, in my mind, there are 7 key ones. Okay, now some of these for some of you will be, you've done this, but there are people watching this that you've got to start from the basics. So the first one is a bank reconciliation. Okay, you've got to make sure that your bank in your accounts agrees to your bank statement. If not every day, at least every week. Small businesses will run their business on their bank account. If I've got money in the bank, then I'm okay. If I haven't got any money in the bank, then I'm in trouble. And that's fine for your first year in business. Okay, if you're running your business after a few years still on your bank balance, then it's like staying in kindergarten. So bank reconciliation, I'm not going to go into detail on it, but it's basically it's so easy now, because if you're not running an account system, really, you shouldn't be in the game. Get an account system, it does it for you automatically. It downloads your bank statement and it matches it up. Okay, so, but I'm not going to go into detail, but you've got to do that on a day-to-day, week-by-week basis. Otherwise, you're out of control. The next step up from that then is a cash flow, a weekly cash flow, money in, money out. Okay, so just check in, you cash in, cash out. If you're at that level, I've got templates of this that will give you that, and you can just record the money, and you can project. You can project forwards, but it's just a very simple money in, money out basis. Okay, so that's sort of what I would call level 2. If you want to increase your cash flow, then the simplest ways to do that are these. Okay, number 1, put your prices up. Put your prices up. That will put you put £1 on your sales, that £1 goes straight to your bottom line. No cost to it, no effort. It really is the easiest one. Now, why are people scared of putting their prices up?
Competition, maybe, might not drive the sales you want, might reduce your sales.
Yeah. If I put the prices up, I lose my customers. Okay, now the reality of it is you won't, because, you know, and even if you do, if you increase your prices by 10%, depending on your margin, you can lose up to 25% of your sales and still make the same amount of profit. So you've got to be thinking of how do you do this. Yeah, not necessarily do it in one go, not necessarily across the board, but you're always in the back of your mind, you know, is now the right time to increase my prices a little bit? And the weird thing is, you know, if let's say inflation, I mean, it hasn't been for a while, but let's say inflation is running at 2% per annum, yeah, and you don't put your prices up by 2%, that sort of says to the customer, you're actually overcharging them last year. Because, you know, cost of everything's gone up by 2%, therefore, you know, this price was 2% too high last year if that price is the right price this year. So you owe it to your customers to put your prices up. And where I've done it in the past and helped people do this, we've had times where customers have come back and said, you know, thank God you've done that because I've always thought you're too cheap. People's perception sometimes is a negative one because you're too cheap. So don't be scared to do it again. Ignore the emotion, look at the numbers. Is it the right time to do this? Can I do it? And if you put them up, you can always put them down again. You know, but I wouldn't, you know, very rarely do we say put it up across the board, but it's the quickest way to get money into your account. If you want money in your account, what you've got to do is reduce your balance sheet. I'll come more into balance sheet later, but you want to reduce the amount you've lent to your customers. You want to reduce the amount that you've got sitting around in stock. You want to reduce the amount that's sitting around in assets. Yep, so that would be first, and then you reduce the cost of sales and overheads. If you do all of those and you still need more money, then you have to borrow the money. Okay, and I'll come back to that when we look at the balance sheet. So those are the only ways you can actually increase cash into your business. Oh, and obviously sell more. So sell more, increase the quantities, increase the prices, but don't forget to actually, you know, keep an eye on that balance sheet, because that's where the money gets tied up and you can run out of cash, not because you're not profitable, just because you're just bad cash flow. So then we look at generating cash through our debtors and creditors, you know, and these are the ones that I sort of way to do that. First, you've got to understand who owes you what, how long it should be outstanding. So you need an aged debtor report. So I've got one of those there. So that's just straight off the system. And you can relate that to a debtor's days. So you take the debtor amount, or the debtor days is the debtor amount at the month end, divided by the sales for the year times 365. Okay, so there's a little calculation to actually work out how many days your debtors owe you money. But if you think about it, if you give 30 days credit, yeah, and you work out your debtor days and they're 65, then you are lending your clients money for nothing for 35 days, for free. If you went to your bank and said, could I borrow £100,000 please for 35 days, and I'm not going to pay you any interest or give you any security, what's your bank going to tell you?
It cost you.
Yeah. So there's no way I'm going to do it for free. So therefore, why are you doing it for free? Now, unfortunately, in some industries, people are so lax on this, the whole industry is lax, that 30 days credit actually means nothing. Industry standard is 65 days, you know, or we pay you when we pay you. So the way I recommend we get around this is we put clauses in our T's and C's that says there's a late payment of interest at 5% per month. If you want to borrow my money for 35 for a month, yeah, it's going to cost you 5%. The statutory is 8% above base. And what's base rate at the moment?
0.25?
1 point, I thought 1.5, 1.5, is it?
No, not 0.25.
0.25.
So therefore, they're borrowing at 8.25% per annum. Unsecured. Yeah. Do you think you could go to the bank and get unsecured borrowing for 8.25% before Sybil's and bounce back loans?
No.
No. So if you're only offering that, you're actually offering a really good finance deal. Whereas if you change your T's and C's to 5% per month, yeah, which is 60% per annum. I mean, it's still cheaper than Wonga was. I mean, Wonga was about 4,560%. And when we do this, what if you said to your clients that you're going to charge them 5% a month for an outstanding balance, what's the first thing they're going to say?
When can I pay?
Hmm?
When can I pay? How can I pay?
That would be nice, but what's the negative thing they're going to say? Do you think they might object to that? Yeah, they might look at it and go, oh, you can't charge me 5% per month for outstanding payments. So what's your response to that?
Don't charge them.
Well, my T's and C's say 30 days. So if you're not going to pay that, that means that you're going to pay late. If you're going to pay late, let's sort that out now, because I need to put my prices up to allow for the fact that I'm lending you my money. They've nowhere to go, because, if they argue about the 5%, you can say, well, does that mean you're going to pay me late then? Well, no, but I might pay you late. Well, that's fine. If you let me know you're going to pay late, yeah, and let me know a week late, okay, I can live with that as long as you tell me. But if you want to borrow from me, then my rate is 5% per month, and that's what you've got to get into your head. When people pay you late, they are borrowing money from it. And is it better in their bank account or your bank account?
Yours.
Yours. And the other thing with credit control, yeah, and avoiding this is when they are, because some businesses certainly the last year have been strapped for cash. Okay, and it's not about being that bastard of a customer that sort of demands their money. If people talk to me and explain it, then I'll work with them. But if they're not paying you, do you think that they are not paying anybody?
They're probably controlling the people they can get away with not paying, because of the relationship that you have with them.
So they basically, let's say they owe 100,000 and they've got 50,000 to play with. Half the people are not going to get paid. So how do they choose which half of the people to pay?
Those who shout loudest, or those that are critical to their ongoing business?
Those are critical, and those that shout loudest. So what do you have to do?
Out loud.
Shout
loud and be critical. Fine. It's going to cost you every month. I'm going to send you an invoice for 5%. If you want to keep racking that up, fill your boots. Okay, if it gets too bad and their credit rating shit, then you need to call it. But too often we're too emotional. We think, oh, what if we chase it and they get upset? Well, if you were a day late delivering your goods or your service, would your client get upset?
Yes.
Yeah. So you're a day late paying your bill, therefore I have every right to be upset. So we've really got to think. Debtors is such a key fundamental. It's cash that you could be using to grow your business. But if you're willing to just hand it out to people willy-nilly and let them keep it, then you're never going to grow your business. And when somebody comes to value it, they will take that into account, and that will be written off the value of your business. So the next item is your profit and loss. Okay, so it's really looking at on at least a monthly basis, you should be reviewing the sales that you've recorded, your cost of sales, your gross margin, your overheads, and your net profit at a minimum. Okay, now you can show it in any format. You show it as graphs. This is the way I like to see it. Okay, on a month-by-month basis is a simple summary headline. This is me sitting in my managing director's role. This is not me as a finance director. Okay, but me as a managing director's role, this is all I need to see. Nice and simple. What are my sales? What are my direct costs? What's my GP? Where are my overheads going? Broken down into the key areas. What's my net profit? The type of accounts that I get from accountants and off systems is a fucking load of data and load of numbers, that I just look at and go, how can I make decisions on that? Yeah, your P&L needs to be tidy. It needs to be the right things in the right places, so that I can make decisions. I can make decisions here. My salaries, 960,000. Are they going up? Are they going down? What a percentage of my turnover are they? Are my establishment costs in line with it? Yeah. Am I spending enough on sales and marketing? What's my finance? These are high level numbers that me as the managing director, this is what I need to understand. If I'm now putting my finance director's hat on, I need now to go down into more detail. So I need to be looking now into the breakdown. I need to know how many units are being sold. As an operations director, I need to know how many units I've sold, what my average transaction value is. What's the profitability per line? I need more granularity down here when I'm down in the operations director, because go back to what I said before, is MD's in charge of net profit. Yeah. Operations director is cost of sales. So that person needs to understand how the mechanics of their business is being made up. And Gary, you were talking about pricing. This is all about pricing. Okay? If you don't know how this works on what you're doing basis, then you can't set your pricing strategy. You've got to know this, and then your pricing strategy comes from that. And then I put my finance director's hat on, because finance is in charge of overheads. I'd want to see the breakdown of the overheads down into its component parts. So this is two levels. Managing director level is here. Okay, so as the MD, that's all I'm interested in. As the ops director, I'm interested in my cost of sales and GP. And as a sales director, marketing director, I'd be interested in that as well. Yeah, and then as the finance director, I need the granularity down into overheads. And if I'm so the next phase from that is I'd want to now start seeing this compared to actuals and budgets. Okay, and I'll go on to budgets in a minute. So I'd see this month here, last month, budget. So I must get a copy of that actually. So are there any items on the P&L? I mean, the P&L generally is the easy one. Most people look at, most people do understand, but are there any terms on the profit and loss that you don't understand, you know, that I can help you with? And say, please, you know, there's no wrong question, no wrong questions here. If you're not sure, this is the time to ask. So. You're happy with that? I mean, it's generally most people do understand it. It's income expenditure broken down to its areas. Okay.
Kevin, okay, just a quick one. How do you get your direct labour at the top if you've got salaries in your overheads?
Right. So the direct labour, so direct costs. Can I? Let me just see. Can I come back to that, David? Because I've actually got that when I look at budgeting. And
that's cool.
I'll be explaining it then. Okay. But yeah. The key to this is the real answer to your question. It doesn't matter as long as you're consistent. You understand what and why you've done it. Okay. I just choose this because I've been doing this for 30 odd years. And this is the format that I just prefer. Okay, it just works for me. Does it have to be this? No, it can be whatever you want it to be, as long as you understand it, you've created it, and you're consistently applying it. Okay, but I'll show you that in a second. Okay, so the one that causes a bit more problem is the balance sheet, and this is the one that people don't use enough, and they ignore, and you ignore it at your expense. Okay, I've had one company I used to work with ran their business just looking at the profit and loss account, and it turned out that the accountant was actually making the figures up on the profit and loss account. And they didn't know until the VAT man knocked at their door and asked for £80,000 in overdue VAT. And the accountant then just disappeared. And this was somebody they knew and liked and trusted, but you never abdicate the responsibility of your accounts. You, as the owner, as the shareholder, must always look at the accounts. You must always look at the profit and loss, and you must always look at the balance sheet, because the balance sheet is like the carpet under which all the shit is swept. Okay, and if you can't read a balance sheet, you don't know where those piles of crap are. So if the profit and loss is like a river of money in and money out of the business, a balance sheet, so P&L is like it's constantly moving, it's in, it's out, it's in, it's out. A balance sheet is a snapshot. It's like musical chairs. When the music stops, how many chairs are left? So it's a snapshot of the assets, and the liabilities of the company at any point in time. And what we've got to look at is, it's really actually far simpler than that. It's really where the money's come from and where the money's gone. Because if I said to you right now, James, at this point in time, how much cash has the company got in its pocket?
It'll be checking the bank accounts and do all the
No, not bank accounts, actual cash, actual pound notes that it can actually, you could go and get from the office right now.
£20 is in my wallet.
£20 in your wallet, yeah.
Oh.
Dave.
Yeah, okay. Petty cash.
Petty cash, which is what? A couple £100?
Yeah.
So the only cash that you can actually account for right now is £200 of petty cash.
Yeah.
Okay. So the rest of the money has gone somewhere, isn't it?
Absolutely.
That in a petty cash tin. So the balance sheet is a record of where the money's gone, and because it's gone somewhere, it must have come from somewhere in the first place. It's an in and out, yeah, and we're keeping track of all the ins and outs, and then we go stop at the end of the month, freeze, right, where is it? So where it can go is it can go into our fixed assets, our land, buildings, motor vehicles. So you could say, well, actually, I've spent it over there. You can go and touch it. Yeah, it might be intangible assets where you can't touch it, but you've got some form of paper record that it's gone over there. So that's your intangibles. It can go into your current assets. So these current assets, so fixed assets last more than a year. So the same asset will be there in 12 months' time. A current asset, the category will be there, but the actual physical thing that is here this month may not be there at the end of next month. So stock, the value of stock will be there, but the actual physical stock item may not be there in a year's time. It's more fluid. So it can go into stock, it can go into debtors, it can actually go into a bank account because the money's gone from your petty cash tin and you've lent it to the bank. Yeah. And how much are the bank paying you now for borrowing your money? Nothing. They're charging you for it. Isn't that nice of them? Thank you, Mr. Bank Manager. They look after it. And then we can lend money and you know what prepayments are?
Payments in advance.
Yeah, so they're payments that we've made now that we will get the benefit of in the future. So I might pay my rent 3 months in advance and I'll get the benefit of that over the next 3 months. Okay, so it's just a payment I've made for future benefit. Okay, so those are really the only places my money can disappear, and that's why if I want more money into my business, I need to reduce these and bring it back. I need to sell those vehicles that I'm not using, bring it back. You know, I need to reduce my stock, bring it back. I need to reduce my debtors, bring it back. Okay, the only one that we're sort of saying is actually I'm not going to hold the cash in my petty cash tin. I'm actually going to put it into my bank account because that's really fluid cash there. But where's the money come from? Well, it comes from liabilities. So it comes from borrowing from the bank in an overdraft. It comes from borrowing from our creditors because they're very nice because they lend us with 30 days. Yeah, they don't have really good terms and conditions. They don't charge us 5% per month for borrowing their money. So thank you very much, Mr. Creditor. I'll borrow as much from you as I possibly can because you don't chase for it. Yeah, and if you do chase for it, I'll pay you. But if you don't chase for it, I'll sit on it because I need it more than you need it, obviously. And that exact same conversation is going through your customers' minds as well. If we borrow from the government, it's because we take in the VAT money and we don't have to pay it back to them for 3 months. And we take it from our employees, from their national insurance, and we don't pay that over for until the end of the month. We can borrow loans, and accruals are the opposite to prepayments. They are expenses that we've used the service, but we haven't actually paid for. So where we're using advance and then pay for it later. Okay, so that might be something like electricity, where I'm using electricity now, but I don't pay it for a month's time. Okay. Or it can come from the owners, in which case it can come from shares, so money that I've put into the business by buying shares, or reserves that I've carried forward from previous years, or the net of my income and my expenditure, for the period in question. So the balance sheet is purely a record of where the money's come from and where it's gone. So you've got to look at this on a regular basis to make sure that your money isn't in the wrong place. Ideally, you want it in the bank account or in assets that are generating you money. So I've got one client at the moment, because of Brexit, because of lockdowns, over the last sort of 3 months, he's been stocking up. So his stock has gone from 1 million to 1.5 million because he knows that there's going to be a shortage as lockdown sort of comes out, and therefore he's going to realise that cash, that money. So he's going to make money on that. So that was a conscious decision to buy more assets to generate more revenue. So everything in here must be a conscious decision. Is that the right place to put it? Because if it's not, then reduce it, put it in your bank account, do something with it. Okay, so any questions about balance sheets, that anything on there that people don't understand? And that's why I say, when we come to evaluation, yes, it's important, but it's not the most important, because this could be zero. All my debits and all my credits can balance out. I've still got an extremely great business because it's still able to generate me £1 million a year. If I've got too much over here, then I become too fat. Over here, I'm too lean. I've just got to get that balance just right between the two. And that really depends on where you are, what type of business you're in. But we do have to look at it to make sure. Number 6 is our budgets. Okay, so that all of that we've talked about so far is looking backwards. It's all history. It's all, again, driving your car with the rear view mirror. Yes, you can, but you're going to go slowly and you're going to bump into something. Now we start looking forwards. Now we want to start predicting in our business what's going to happen. So a budget is a pragmatic view of what the business can do. We use it, the what if analysis. So we get to play with our budgets. And this is a real bizarre thing, because I was brought up on budgets, from my father when he was, started his business when I was like 12 or 13. He would get we didn't have spreadsheets then. We had extended trial balances. I don't know if you know, pieces of paper, and we'd write it all out. And it was very detailed, lovely handwriting, my dad, and it would all look very neat. I couldn't do it in my handwriting. But now it's all on spreadsheets, and I love budgets. And then I came across my first public sector person, and they sort of saw budgets as a negative thing. Oh, we're constrained by our budgets, and oh no, I don't like budgets. And it was, I just thought, hang on a minute, a lot of people think budgets are a bad thing, whereas actually they are your most useful tool within a business, because they allow you to play with your business. What if I did this in my business? What impact would that have on my bottom line? Where would I be in 5 years if it continued at this rate? They help us set goals and targets. They give us a stick in the ground. Because if I said to you, my business last year had made £1 million profit, would that be a good thing, Neil? My business has made £1 million profit last year.
Oh yeah, absolutely.
Yeah, fantastic, isn't it? £1 million. Yeah. But my budget said I should have made 100 million.
Well, no, that's not such.
It's not so good. Well, see what I said at the start. The numbers don't mean anything in isolation. £1 million profit is just £1 million. It's not good or bad. It's just £1 million compared to £100 million budget. It's ridiculously bad. Okay. Again, I don't get emotional about it. I want to understand why it was £1 million and not 100 million. But then I want to be able to predict what I'm going to do forwards. So it's a measuring stick to measure our progress towards. Okay, and so I don't really care what the budget says. It's just we need a stick in the ground or a line in the ground to know how far away from that I am. And a little thing I use for this. So in the old days when we used to fly places, do you remember that? When you used to get on a plane and fly somewhere? So if you got onto an aeroplane, yeah, and you knew the pilot didn't have a flight plan. Yeah, he was just going to take off, and he was going to fly, from England to to Malaga, where I am. Yeah, and he had no flight plan. He was just going to fly up. He was going to head in roughly the right direction, and he was going to land when he landed. How would you feel about getting on that plane?
No.
No. Okay, so he has a flight plan. It says, where he should be at any particular time during his journey, so we know he can land at that window that he's set or has been set for him to get his passengers there on time safely. Okay, how often do you think he's actually on that flight plan, exactly to that flight plan when he's flying?
Not 100% of the time.
It's about 2% of the time. So you'd say, well, if you're not on your flight plan, you're only on your flight plan for 2% of the time, what's the freaking point around a flight plan? Yeah, what's the point? If you're only to it 2% of the time, why would you bother? And the reality is, James, you're going to.
Sorry, does it find the final 2% landing in Malaga?
Fine, yeah, but
Gets there.
yeah, if you don't have the rest of it, you don't get there on time. See, his flight is this. He's on budget here. 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 Yeah. Compared to the journey, how many times? Yeah, length of time he's on budget. It's tiny. It doesn't matter because it's not when he's on it. It's here. That's the important bit. How far am I away from budget, and what am I doing to get back to it? And that's, in my mind, why people don't do budgets and they're scared of budgets, is because they say, how can I predict what's going to happen next year? Now, things change, things happen. Yeah, of course they do. But unless you know how far away you were from where you wanted to be, then how do you know what you need to do to get back on course? And that's why we've got to have a budget. That's why it's so important. And, you can add into there that, sometimes you need it to convince the bank or a lender to borrow money. But if you only ever do budgets for that, you are missing the whole point of having a budget. You should not fly a plane without a flight plan, and you should not fly a business without a budget. Okay, and it sets your reticular activating system to actually go after it. So if you can set this and say, right, well, actually, why don't we set it up here and see if we can get there? Even if we come down here, I guarantee you'll be at least 10% better than you would be if you hadn't gone after it in the first place. And often you'll surprise yourself how close you actually come to it. Okay, now all of you have done the 5-year plans and things like that. That's all part of this process, to say where we're going to be in 10 years. I don't need much detail at that stage, but as we come back down, we need more and more detail. So first thing within our budget is we need to know what break even looks like. Okay, so we have our fixed costs here. Yeah, we have our variable costs in addition to our fixed costs. So our variable costs would go there. And we have our revenues here. Okay, so that point there is our break even, where that should be our, I've got that wrong, that should be total cost. Okay, our total cost, so our variable cost plus our fixed cost is there, and that's the break even point. So down here we make a loss, and up here we make a profit. So we've got to understand at what point, what volume of product do I need to produce in order to cover all of my costs. If I don't know that, then again, I'm flying blind. So the first budget you do has got to be a break-even budget. What do I need to do this year to stand still? Then I'd want to be pushing it up here, and then I would do my what if. Well, what if I did that volume? What if I did that volume? And then we can decide, right, where's my target actually going to be? If I set a high target, even if I fail and come here, I'm still well above my break even. Shoot for the stars. If you hit the moon, you're doing pretty well. Okay, so Going back to, I think David's sort of point here, you know, we've got, so if we go back to here, our fixed costs and our variable costs, our fixed expenses are those expenses you pay whether or not you have a sale. So if I've got rent to pay, yeah, if I sell 1 unit or 100 units, does that affect my rent?
No.
No. Okay. Variable expenses are those expenses incurred because I have sales. So yeah, if I sell widgets and a widget costs me £1 and I sell it for £2, yeah, and I sell 10 widgets, yeah, what's my cost of sales?
What are the figures again? Sorry, Kevin. Was it 10 widgets,
So,
you said?
10 widgets at £1 they cost, and I sell them for £2. I did try and keep it really simple, so you don't have to think too hard, but it is late in the day, so.
It is, you're right. Okay.
Okay, so my fixed costs stay the same, and my sales do this, and my variable costs do this. Okay, so they're always, so a variable cost is always in relation to what I'm actually selling. Now, a direct cost might be part fixed and part variable. And that really, one of the key ones to that is labor. There's an element with labor that is fixed because I've got to employ these people whether I sell units or I don't sell them. But the more I sell, the more people I need. The differential I would always put, and why I would put it what I call above the line, so within my gross profit calculation rather than my overhead calculation, is if that labor is directly associated with a sale, then it's a direct cost and it goes above the line. So anybody who touches something that gets sold, yeah, is above the line. Anybody that doesn't touch something that gets sold, like administration, you know, sales, marketing, you know, they don't actually touch what is being sold out the door, would be an overhead. The reality, though, is you get to choose. You can allocate it. You know, sometimes it's, well, I'll put 50% above the line, 50% below the line. Yeah. Sometimes you can work the hours, so they work 10 hours in direct sales and 10 hours, you know, in overhead, and you can do it that way, portion it. Again, doesn't matter as long as you're clear why you're doing it and you're consistent. Those are the two factors that you really need. Good. So any questions on budgets? So if you want to calculate your break-even point, it's your overhead divided by your gross profit, gross margin percentage. Okay, so if I do a little calculation, if I've got if I've got 100 sales, 50 cost of sales, 50 GP, 40 overhead, and 10 profit. Okay, just simple calculation. If I wanted to calculate this, my GP is 50%. Yeah, 50 over 100, 50%. I would take my overhead at 40, divide that by 50%, which would equal 80. So I know that I've got to do 80 sales in order to make money, and I can calculate that by putting 80 in there. 50% GP is 40. Yeah, 40 overhead, which is 0. Okay, so I can work it both ways. Now I realise I've gone through that quite quickly. Yeah, again, this is where you play with it in your budget, because you can start to work out different gross profit percentages, different overheads to come up with different break-even positions. And obviously we want that break-even to be as low as we possibly can, so the more units we do, the more money we make. Okay, any questions on that? On budgets and break even? All good? Fabulous. So our final section then is key performance indicators. So again, I've gone through, basic, sell the bank balance, then cash flow, then profit and loss, then balance sheet, then budget. So we're building these layers on. So I'm not saying everyone has to go straight to these. KPIs come once you've got those basics in place. You can't fly your plane unless you've got those, those fundamentals. Once you've got those, now we're going into the granularity and really looking into detail. So we now need to start to measure what really matters within our business. Okay, and there's this little phrase: you don't need to know what goes under the bonnet if you have a dashboard that tells you how you're performing. Yeah, you've got to imagine you're flying your plane and the dials there are telling you what's going on. You don't need to know how to fix the engine. You don't need to know how to do things. You just need to know what they're saying and what to do as a result of it. And as you build your team, you'll have specialists that will know that. But you've got to monitor it to actually direct them and help them achieve what they need to achieve. So if we go back to our organizational chart, okay, back to here, we've got to have KPIs for each of these. Okay, so we know what the shareholders' KPIs are. That's profit and shareholder value. MD's is profit, yeah, and therefore our KPIs have got to be around these 5 functions. So around sales and marketing, we're looking at our funnel. Okay, we need to know what the number of leads coming in is going to be, what the conversion rate at each stage as we go through. Each source that goes through. Where do my leads come from? Is one marketing strategy better than another marketing strategy? What's my return on investment on this strategy compared to that strategy? Okay, the more numbers that I'm aware of as we go through, the better. And the starting point really is what we call the 5 ways. How many leads are coming in? What's my conversion rate? What's my number of transactions, my average transaction value, and then margins, which goes back into the financial profitability. If I'm carrying out jobs, if I'm on a per job basis, then I need to know this per job. What are my costs per job? So really around these 5, or certainly 4 of the 5 ways is what I'm looking at. So this is this is sort of marketing, this is sales, this is account management. Okay, so I need to know these numbers for each of these departments. And then margins is operations, which we'll come on to in a second. Okay, so the more we can measure, the more we do, the better. Now, the beauty with online, a lot of our stuff now is measured for us. If you've got Shopify, Magento, those systems give you amazing amounts of data. Google Analytics gives you an amazing amount of data. Sometimes too much data. And if we have too much of it, sometimes we can say, I can't be bothered to look at it. Forget about that. Find something that you want to work on. Measure what matters. Measure something and then improve it. That's the key to this. Find what your key result is for that quarter, measure it, work on some strategies, and improve it. Operationally, we're basically looking at these 3 things. Can I deliver it on time, on budget, on spec? So have I got measurements around time that goes into it, my cost of sales that goes into it, and quality? So there's 3 indicators straight off. Each one of these can be broken down into multiple sub KPIs as well. If you want to look at what's important where you start, then start with your most limited resource. Okay, in a lot of businesses, certainly manufacturing, Gary, anyone in trades, your biggest limited resource is time, because each new person costs you money. And I said before, they're not necessarily, while they're a direct cost, they're not a variable cost. You have to invest in them first, then you have to get the work out of them. But it might be materials, it might be space. I only have a limited space. So you're looking for this key rate per something, rate per hour, rate per unit, rate per meter squared. In the operational thing, what is the rate per something? And that's what you've got to find. What is the, and I always start from the end in mind. What's your biggest cost? Start there. Okay, look at what's happening, how you make money, and start with the biggest number, because if you can improve that, you'll get the biggest impact on the bottom line. And then you're breaking it down into marginal gains. When we're in KPI level, we're not looking for massive, 10, 20% improvements. We're looking for 1% improvements. But if you can get 101% improvements, you'll have 100% improvement on the whole lot. But again, this takes time, it takes effort, it takes brain power, but above all, it takes your ability to record. And that's why you need systems and processes that are automated to give you this information. Okay, so it doesn't happen overnight, but as you grow your business, this is always in the back of your mind. How am I building my metrics to measure this so that I can make better, more informed decisions as I grow, as I move forwards? So that's sales, marketing, operations. Finance we've already dealt with. That's the the P&Ls, etc. The final one was the people, and this is the one that often is the hardest to measure, because the others are all substantive. There's generally a number related to it. People is a lot more subjective. Okay, but there are key measurements that we can use. And often we're looking at leading key performance indicators. If we're looking at retention as being one, then sick leave and absenteeism are leading KPIs to retention. If sick leave and absenteeism goes up, then retention goes down. Performance can be about happiness. If my guys are engaged and happy and working really well, then I'm generally going to get high levels of performance from them. Okay, and and then we're going down into growth. So as a whole, how much has my team grown in their knowledge and their skills? Well, a measurement on that is how many training courses have they been on? Because if they're not going on training courses, they're not growing. Engagement is something we can actually measure now. We've got systems that can actually do surveys and measure levels of engagement. But sometimes if you don't have a substantive number, then walk around, ask people on a scale of 1 to 10, how engaged are you in your job? And I was with working with a client the other day, and he's doing a staff survey, and he said, I'm doing a staff survey and I've got some results back, some really good results. We're getting loads of 10 out of 10s for our staff happiness. And he said, that's good, isn't it? I said, no, it's shit. That's a really crap result. And he went, well, what do you mean? Well, why is that a crap result? So why would I say doing a staff survey and getting 10 out of 10 is a crap result?
It's unrealistic. I mean, I think people, operatives aren't necessarily, if it's the person obviously receiving that information, they're probably going to want to tell someone what they want to hear, not actually how it is. They want to keep the job. Maybe.
Yeah, so the first thing potentially is it's bullshit, because no one, no company is a 10 out of 10. But there's something more fundamental. Go back to the emotion, what I said at the start. What's he suddenly put into that number? His score's come back 10, and he's told me that's a brilliant result, isn't it? So he's happy. He's got a positive emotion.
So he won't work on it. He won't work on it and change his behaviour to make it an 11.
Yeah. Yeah, you think it's brilliant, yeah, and therefore what are you going to do as a result? Nothing, because everything's fantastic. How can you improve on a 10? I said I'd rather you come back with a 2 out of 10 score. If all your team said you were 2 out of 10, then we could do something about it. We'd look at it and we would improve. See what? And I said the problem is you're asking the wrong questions. If you get 10s, you're asking the wrong question. You want to ask questions where, what do you want to improve? Yeah. And if you want to improve it, you should never get a 10. And then you can get proper feedback, and then you can work on right. So it was 5 out of 10. We're going to work on this, and we're going to see if we can improve the score. Because the only reason we measure something is because we want to improve it. And that's why, to me, customer surveys are a bit rubbish as well. Because our fear is we're only going to ask the customers questions that they're going to answer positively for. Whereas actually what we want them to do is tell us that that we've let them down in certain areas. It's nice to have a bit of positives that we can put on websites and we can shout about us, but actually if we want to improve, we need the crap, we need the negative ones, because only by negative feedback can we actually then do something about it and improve. So we've got to be careful, and I see this too many times with staff surveys. We're trying to reinforce that we're brilliant, because we've put an emotion on it. We want to feel good. We want to feel loved. We want to feel brilliant. Yeah, but it doesn't help us to grow. We've got to ask the tough questions. Yeah, we've got to be prepared, non-emotional, not get upset when we get negative feedback. So brilliant. Thank you for that feedback. That's brilliant, because now I've got room to grow. And if I grow, I improve. If I improve, the business improves. So a good book around this, is our current book of the month. So we're doing this on 2 weeks' time, 2 weeks Friday, and John Doerr's Measure What Matters. So it's a system that he used to transform Intel and then took into Google and a number of other companies as well, to actually help them to really look at these the key performance indicators in businesses, set key results, and get clarity so that people can play the game better. And that's underlying all of this is there is no point in you having all this information and keeping it to yourself. You've got to share it amongst your team. Okay, they're playing the game. Anyone in your organization, if they don't know what the score is of the game they're playing, they will not play it to the best of their ability. Your job is to give them the information and then help them to be better. Coach them to be better players at the game that they're playing. And sometimes the first thing is you've got to help them to understand what game they're playing and how it fits into the overall game of business, which is make profit, make your customers happy. So, home fun. Make sure that you've got your budget in place. Make sure your profit and loss and balance sheets are coming off on time. Should be within 2 weeks of the month end. think about your limiting beliefs around money, okay? Because self-awareness is the first step to change. You know, if you're not self-aware that you've got limiting beliefs, then you won't change. If you've got a fear of money, if money to you is a bad thing, if you have negative emotions about it, if you have too positive emotions about it, then, you know, please come and talk to me about it. Bring it up at a coaching session, because, you know, if we don't overcome those, then they will hold you back. And if you've got all those in place, then start work on that KPI dashboard. Choose an area that you want to improve, find some metrics, record them. Don't, you know, no emotion in it. It's just a number. It's just a reflection of past activity. And then let's focus on what we can do to move it forwards and make it better. Fabulous. Good. Any questions? Have I answered all your questions from the start? So where did we get to? So James, yours was key financial metrics for the business, performance and health. Have I covered enough of that?
Yeah, all good. Good starting point.
Excellent. Neil, knowing how the numbers on the top line affect the bottom line.
100%. Yeah, I mean, it's obviously what we've done previously. It's obviously that's really, you know, sinking in. I know we've covered some of this, what you've covered today previously, but obviously a lot more detail today.
Yeah.
So no, absolutely. 100%.
And that's what I always say. Look, yeah, I do these every 3 months. You know, you don't need to come back perhaps next quarter, but certainly within the next year, come back again, because there'll always be something new that you'll pick out, and it'll just sort of remind you of an area that you need to focus on. So, okay, but do keep up on the books. The Measure What Matters is a really good book to get involved in, and come along to the book clubs as well. That'll be good. Gary, hopefully, so Gary's got some good pointers from that, and Dave, when he plays the recording, hopefully he's got enough about his budget planning as well. So good. Any final questions?
No, all good. Thank you, Kevin.
With that, excellent. Well, look, been great, great audience. Thanks for your participation. Have a super day tomorrow, and hopefully it starts to warm up for my impending return back to the UK in a couple of weeks' time. So I'll see you soon then, guys. Take care.
Yeah, thanks, Kevin.
Enjoy last game of golf.
Thanks, guys. Cheers.
Cheers. Bye.